Welcome to this evening's session that we've called Crossing the Pandemic Divide, an evening with a very talented member of Beth Shalom, Philip Lieberman. First and foremost, many of you may know me as the cantor of Beth Shalom Synagogue. So what business do I have trying to moderate a session such as this evening? And the answer is as follows. Long before I decided to become a chazan, I pursued a path of business, getting my BBA and my MBA from the Schulich School of Business at York in 1994. And following that, I took the Canadian Securities course and then ultimately went to cantorial school and became a chazan. So I never fully worked in the field of finance, but it has been a passion of mine for many, many years and has stuck with me ever since I finished my university studies. But that's about me. But tonight is not about that. It is about Philip Lieberman and the insight that he's going to share with us. So a few words about Philip. Philip Lieberman is a partner and registered portfolio manager at KJ Harrison Investors. He has over 30 years of experience in the investment industry, finance, and capital markets. Prior to joining KJ Harrison, Philip spent 12 years at Scotia Capital. Prior to embarking on his career of wealth management, Philip practiced corporate securities and mergers and acquisitions law at Megan DeMers LLP, now known as Norton Rose Fulbright LLP. Philip manages investment portfolios on a discretionary basis for high net worth individuals and families throughout Canada, including their trusts, estates, and holding companies. Given his deep experience in both law and finance, Philip is first and foremost a manager of risk for his clients. Philip received a Juris Doctor degree from McGill University in 1991 and was called to the Bar of Ontario in 1993. Philip later received a joint MBA from the Kellogg School of Management at Northwestern University in Chicago and the Schulich School of Business at York University in 2005. The only thing missing from that, Philip, is he didn't later go to cantorial school. Philip is actively involved in the broader community as well as the Jewish community. He is a member of the board of directors of the National Ballet of Canada, serving as chairman of the Pension Committee and a member of the Joint Investment Committee and its Endowment Foundation. Philip is a member of the Leaders Cabinet of Sick Kids Hospital, a member of the Israel and Overseas Committee of the UJA, a member of the Board of Trustees of the Beth Shalom Synagogue Foundation, a member of the Board of Directors of Beit Halochem Canada, and the Board of Governors of the Friends of Simon Wiesenthal Center. Philip, his wife Sherry, and their children Brittany and Aiden open their home every year and generously support the Peace of Mind program for Israeli soldiers whose army units have experienced emotional trauma. Above all, we know Philip is a devoted member of Beth Shalom Synagogue and our daily minyan, where he is in the starting lineup, having led just a few hours ago at Mincha, leading service regularly with his impeccable Hebrew and beautiful voice. So this evening, we would like to cover a few topics. In fact, we're going to cover 8 main themes, and I'll give you the breakdown of the 8 so you know what you're in store for this evening. We'll begin with an economic overview. We'll follow with real estate, investment themes within the equity markets, government debt, the federal budget, cryptocurrency, personal debt, and lastly, asset protection and retirement. So I'd like to begin with a big and broad question. It goes as follows. You ready, Philip?
I'm ready.
Okay, he was born ready. The level of economic disparity in this country has greatly increased. What I mean to say is that the wealthy have gotten wealthier throughout the pandemic by owning a home, and for some a cottage or a second home, by being invested in the equity markets while still earning a paycheck. Meanwhile, they are spending less because there is nowhere to go and little to do. On the flip side, there are so many struggling to pay their rent, survive the ongoing small business closures, are living paycheck to paycheck, and owning a home is seemingly out of reach to them. Has the pandemic created greater economic extremes in Canadian society, and is there a way out for the middle class?
So firstly, Eric, Cantor Eric, thank you. we share similar paths, and you sort of beat me to the punchline because I was going to say the one thing I always wanted to be was a cantor. So we sort of like two ships in a sense. But thank you for having me, and I'm delighted to be here. Obviously, we've got about an hour altogether. And one of the things that I've always loved about what I do is you get to cover so many areas of life: politics, geopolitics, economics, markets, law, capital markets, finance, psychology. And that's what makes this business so interesting to me. You know, in terms, Eric, of the kickoff question, what I'd say is, you know, absolutely, it's been a very, very uneven 14, 15 months here since the global pandemic really broke in Canada and unfortunately found its way across the world. And, you know, in many senses, I don't want to label it as such, but I just think it's a truism that, you know, the pandemic really is a bit of, not entirely, but many people have termed it more of a blue collar pandemic, in the sense that the hardest hit parts of the economy have been some of the lower income service industries, manufacturing industries, essential service industries across not just Canada, but the United States, North America, and the world for that matter. So it has been a very uneven. It has accentuated inequality and exacerbated, I think, inequality in Canada and across North America and the world for that matter. And I think that not that there's no way out, there is a way out. You know, the title of this is Crossing the Pandemic Divide. And for those that couldn't quite figure out what I meant by the title, you know, this pandemic has created, you know, think of it as a huge valley in the world that threw the world into a global economic recession of which we really haven't seen. I mean, even people have analogized to wartime, but in wartime, you know, it could be the inverse of recession because you're manufacturing war equipment and ammunition and food and pots, etc., all the things you need to send your soldiers off to war. This is something that we haven't seen in, you know, 100 years plus, perhaps since the Spanish flu, which probably none of us on this Zoom call were around way back then in 1918. So I think that it created this deep valley, and the bridge is the bridge that I'm referring to is a combination of economic stimulus, monetary stimulus, and we'll get into some more of that later on, fiscal stimulus by governments and central banks across the world. And think about a bridge. At the end of the day, unless you complete the bridge across the huge valley or gully, you're nowhere. And so the question really is and remains, when does that bridge get completed? Are we near completion? We can use a baseball analogy. What inning are we in? Sixth, seventh, eighth. Some of it is related to the vaccination rollout globally, which we can talk a little bit about. But at the end of the day, it has for sure exacerbated socioeconomic inequality across the globe. What's the way out? It doesn't necessarily need to be that way, although we all know as a practical matter, we always have social inequality, socioeconomic inequality. But what's the way out for the middle class and the lower is obviously to get back to work, to take down the significant unemployment levels that were created. Unemployment has come down, but of course, again, the hardest hit areas, the very hardest hit areas, the services businesses, think about food and beverage, think about manufacturing, distribution that constantly are getting locked down, opened up, locked down, semi-opened up. Those are the hardest hit. As soon as we can kind of finish crossing and completing the bridge, but again, I'd almost put the question back to you. You tell me what's going to happen with the pandemic, and I'll tell you where the economy will go. Clearly, the vaccination rollout is the linchpin globally in Canada and elsewhere to crossing the divide and completing the bridge and allowing overall growth to come up, which will bring up all boats, including those most impacted by it. Not necessarily equally. There's going to be permanent fallout from this and permanent change, but it will, significantly improve the lives of many that have been hardest hit.
No, you touch on something in the particular, the fact that this may shift the paradigm permanently, economically speaking, the way people choose to live their lives. And to follow up on what you just said, are there any particular big takeaways from the pandemic, either from a micro or macroeconomic point of view, that will linger with us for a generation or more?
So, for sure, there's lots of issues that everyone is talking about. And again, one of the other, great things about this business, everyone becomes an armchair quarterback and everyone's got a view. And, in a sense, that's what makes markets, right? There's buyers and sellers on both sides of the trade, and everything's a trade. But, ultimately, there are going to be winners and losers. But in terms of losers, like many things in life economically, there's transitions that occur and new ways of doing things and new jobs and new opportunities and retraining, et cetera, for the most hard done by. I think that, there are a couple of big takeaways, I think, globally from the pandemic, and certainly here in Canada. I mean, first and foremost, pandemic preparedness. I mean, I think that we can all agree that we once had an early warning system, and without getting too political, it went by the wayside, and that needs to come back and be improved because, again, it's our hope, and God willing, we don't see another pandemic in our lifetimes and for another 100 years plus. But I think the fact that the early warning system went by the wayside is problematic. Secondly, what I'd say is it certainly, the light shone bright on the fact that we lost domestic native pharmaceutical manufacturing capability in our country. And I think, again, that will be something that gets focused on in the near term. The other thing is to look at best practices, and you look at, of course, Israel, but Australia and New Zealand, and some that I would say were best in class in terms of acting quickly, not necessarily perfectly, because Israel itself wasn't perfect. It went through successive kind of opening up and locking back down. But a couple of things that it did do, big picture from the get-go, like Australia and New Zealand, was much harsher enforcement of the closure of international borders to stop the spread of the pandemic, to temporarily stop immigration, tourism, etc. And that helped. And finally, I think what this shines a light on is, government's balance sheets and the positions economically that governments are in. And, I'd say that thankfully, in this pandemic, generally speaking, including Canada, governments' balance sheets were in pretty good shape to sustain and to react and deal with the pandemic. And again, we can talk more about that because, of course, everyone looks at Canada and is like, how are we going to pay for all of this spending and wage subsidy and rent subsidy, et cetera. And they're all real issues. But I think that at the end of the day, we're very fortunate that Canada had a balance sheet that could handle it, not without pain down the road, but it's manageable.
Well, you pointed out some really key points there. In particular, the fact that Israel managed not only the pandemic side of things, but the rollout of the vaccination when you have a prime minister that thinks like a businessman as opposed to thinking like a drama teacher, who actually paid double for vaccines, knowing that the cost of closing the economy for a lingering period of time would be greatly offset by paying a little bit extra, even 50% or 100% more than market demanded for vaccines, so that you can get people back to work and get the economy rolling once again. So I want to talk about government debt on that note, because I feel that the government has been busy playing catch up all throughout the last several months, and they're basically like the Titanic sinking. They know they don't have enough life jackets, and everybody's running around trying to figure out how to, plug the holes when you just don't have the equipment to fix the problem. So the federal government has incurred record levels of debt, with the burden to service it passed on to your children and my children and likely our grandchildren. Does this level of stimulus make sense, or does it only serve as a stopgap measure?
So, it's a tough question, and it's a question that's very emotionally charged. But let me give you a lens. It's not necessarily perfectly correct, because again, for every view there's a counter view. But I think that it's palatable, and I think it is coherent, which is this. I think that, again, Canada, even the US, which has lots of debt, was in pretty good shape going into the pandemic, balance sheet wise. Now, you have to all recall that we are in a period of effectively zero interest rates. And if you equate the pandemic to war, it's different, but it is a huge global event, similar in many respects to wartime reaction, not by armaments and ammunition and soldiers, although soldiers are being used for a variety of things on the vaccination rollout front. What I'm saying is, at the end of the day, you couldn't almost be in a better position as governments and central banks with effectively zero interest rates to say, look, we can go out now. We haven't rolled out 50-year, 30-year, 40-year, 50-year sort of wartime-like bonds and loans for decades and decades, because we didn't need to. And now we can do it at kind of historically low interest rates. What's the government of Canada 10-year is at 1.5 plus or minus. Which again, we'll come to interest rates later on perhaps, but again, there's been a big move in interest rates. A number of months ago, earlier on in the year, late in 2020, we were at 50 basis points. So, but even at 1%, 1.5%, et cetera, governments can go out and raise long-term money. And you're right, it's going to get paid through successive generations, l'ador vador, as we say. Right, but in a sense, it makes sense, because your and my time horizons, unfortunately, are finite. But absent Armageddon in the world is not finite. It's infinite. And so, yes, some of it will come out of our hide, and some of it will come out of our children's and our grandchildren's and our great-grandchildren. But again, the other flip side of it is growth. And what will growth look like? Because of course, as we get to the other side of the bridge and we look at economic growth in the world, again, it won't be fixed in a year or 2 years or 5 years, but growth, of course, plays a big role in taking down debt over time. So it's a little bit of a matrix, if you will, of how economic growth in Canada and globally will intersect with debt that can go out for decades and decades and decades, where the carrying cost is at historically low interest rates.
It's a very fair point. I mean, I just refinanced my own home, and I've never had a mortgage at 1.5%. I mean, it's remarkable. Money is truly almost free. And, I think back to the 80s when my father lost his business and he was paying 21% interest on that debt. So, I mean, it's another hemisphere.
Right.
But
And sorry to interrupt. And to be clear, I'm not making light of the question on a policy by policy basis of what our government and of what we're doing in terms of, is that the right program? Are we throwing too much money here or too much money there? Those are sort of separate sort of policy questions about, how much money we're throwing around and whether we're, being as responsible as we should, or we're being a little bit too light. But bigger picture, I think it's historic low interest rates. You've got long time horizons, and the carrying costs for governments whose balance sheets are in pretty good shape allow us to do this.
I want to ask you a question staying within the government sphere. The federal government recently delivered its first budget, I believe, in 18 months. What are some of the main takeaways from that federal budget? And if any, what was left out of that federal budget?
So look, I mean, I think the good news for most of us on this call that probably we were all sort of fearing, and the noise level was pretty high going into the budget, was the noise around whether the capital gains tax would be increased, and the government decided not to increase it. I'm not an accountant, so I haven't read in detail every bit of the budget, but big picture, here's what I'd say. It was, in essence, a pre-election budget. It threw a lot of money around, to some things very important, childcare, the climate change policies. But basically, in a nutshell, there wasn't a lot of new tax. There were some taxes, but not a lot of new tax, and lots of money being spent on some important programs, some less important programs. I think it was a budget that was really meant to be able to go into an election, should the Liberal Party of Canada decide to do it, with, hey, we're spending money on important things, including childcare. There was a lot of money thrown at, again, crossing the bridge, getting to the other side, so pandemic-related issues. But I'd say between pandemic-related issues, childcare, and climate change, those were the big sort of money expenditures, and not that much that would kind of make you quiver on sort of increased taxes.
I want to pivot away from government now, because we all spend a fair amount of time watching the news cycle. And I want to go to the real estate market. And I'm going to ask you a long-winded question, and you can break it down in any way you'd like. Every day brings a new headline about the soaring residential real estate markets in Canada. So I'll break it down into 4 components. Number 1, why is Canadian housing demand so strong? Is it fair or appropriate for the government to intervene in the natural ebb and flow of the market? Will our children be able to afford to buy a house? And what are your thoughts on the condo market in the city core, which was largely in overdrive pre-pandemic?
Those are a lot of questions. So if I forget any, let's sort of start kind of generally with the housing market and where we're at. I mean, again, housing generally is driven, in my view, by 2 main things: interest rates and employment. So keep that sort of in the backdrop. I think that the reason that housing has, and by the way, we have been talking about housing in Canada and worrying about housing in Canada. Not that we shouldn't worry, because we always should worry, and when my side of the street, we're sort of paid to worry. But housing in Canada has been a worry for 2.5, 3 decades, and every generation seems to have the same sort of issues. We live in one of the best countries in the world, democratic, capitalist, generally speaking, multicultural, very pro-immigration. It's a great place to live. I think that housing is on fire, so to speak, because again, interest rates are near zero. You just spoke about your own refinancing experience. And then secondly, in the pandemic world, and again, we're sort of speaking big picture, you can then sort of delve down into different pockets. You talked about the condo market, which we'll come back to. But at the end of the day, the pandemic has brought about sort of this view around stay at home, remote work. Again, how permanent that will be, no one really knows yet. But it has created, 1 to 2 year shifts for sure. People wanting more space, people leaving condos and apartments in this remote work pandemic world to say, hey, I want more space, and then getting pushed out of the big city of Toronto or the big city of Vancouver or the big city perhaps of Montreal even, and going to other sort of smaller bedroom communities. And even the bedroom communities like Hamilton and Burlington have become very expensive. It's sort of a good problem and a bad problem to have, but it's not a problem that is particular to Toronto or Vancouver. I would suggest it's a problem in London, England. It's a problem in Sydney, Australia, in Tokyo, Japan, in San Francisco, in Los Angeles, in New York City. Miami, interestingly, is one of these peculiar sort of housing economies that sort of goes boom and bust more times than you can shake a stick at. But there are lots of major metropolitan, cosmopolitan cities across the world that have the same sort of issues that we have. I think the bigger problem is, and it's a bit of an evolution as opposed to a revolution, which is Canadians are starting, but just kind of starting, like we're in the third or fourth inning, back to the baseball analogy, of the fact that, Toronto has become a major world-class city as an example. For all the reasons I just suggested, rule of law, democratic, a finance center in our country. It's smaller than the US or the UK, but it's still a central finance and economic center, multicultural, very pro-immigration. It's got a lot of things. And even economically, we can talk about how the manufacturing sector economically over the past decade, 15 years, has gone down in Canada, although I'd suggest that a lot of niche manufacturing has developed over the last sort of 5 years plus. But we've got this burgeoning service sector economy. We've got kind of a Silicon Valley of Canada occurring in sort of the Toronto corridor and related communities. So there are a lot of positives occurring, which makes this a city that people want to live in. And what I think Canadians haven't got their head around, and it's again an evolution, is that, like New York, I mean, it's become very expensive. It's been expensive for decades. Families of 4 and 6 live in apartments, not 500 square foot apartments, but apartments, and they go down with their dog and they take their strollers, etc. We're not used to that. We somehow have become accustomed to that everyone deserves a house with the white picket fence and the 2-car garage. And there's this evolution to kind of the densification of Toronto. And it's happening. You just need to look at the amount of cranes in our city, which I believe right now are the most in North America, if not in the world. But it's an evolution of the way housing is changing in our city. It has become very expensive. I think your next question is, will our children be able to afford it? I don't know. I mean, some yes on their own, some no on their own. But again, I'd suggest that that's not necessarily a massive change from the way things always have been in some of the bigger, more expensive cities of the world. It is becoming more expensive. Again, interest rates are low, but they won't be low forever, or not this low forever. interest rates move with economic cycles, and I would expect that the better probability now is that interest rates are going to go up rather than further down over time. But we can talk about that, because I think that we are in a period, as I say to my partners, that I don't think interest rates are going anywhere drastic in my lifetime, and I hope to live for a long time still. But it's a relative thing. I just don't. I think for a whole bunch of reasons, economic reasons, demographic reasons, we're not going back to 6, 7, 8% interest rates. I mean, you only need to go back to 2017 to see how we went from coming out of the Great Recession of 08, 09, where interest rates again were basically at zero. We kind of started to go up, and we may have hit kind of 3.25, may have touched 3.5 for a short period of time, but I think that it quickly started to then go down way before a global pandemic hit. So there are a bunch of forces at play that are keeping interest rates in sort of a place that are not where sometimes people go, oh my God, I remember when they were 5, 6, 7, 8+%. I'm not sure those days are coming back anytime soon. But for our kids, look, it'll be like anything. I think that at the end of the day, it depends on what they do professionally and in their careers, whether they're going to be able on their own to afford down payments on homes or condos in the city. But I think there's going to be a mind shift that over time that condos are or apartment buildings are an entirely appropriate place for a family of 4 to live, because you see it in all other major cities in the world, and we're just, our mindset is just kind of evolving to that. Sorry, Eric, there were a couple of other questions on the housing.
You hit everything. I wanted to ask you, because it's connected to everything you just said, is government intervention in whichever capacity, they recently had the stress test and they took it away. There's lots of bringing something else.
Yeah. I mean, I think listen, I think it's really important. Again, it's always just a matter of degree, but I think that the government and the central bank are right to be concerned about the housing market. Not because the housing market is evolving, but because you've got record low interest rates. And so you've got a tendency for people to take on lots of leverage, to buy bigger, better, etc., at an assumed interest rate of 0 or 1 or 1.5 or 2%, without the thought of, well, what happens when rates change? So I think stress tests, I think foreign buyers tax, so that we don't have like empty lots sitting around owned by foreign entities, etc. So I think that government intervention of sorts is entirely appropriate to try and dampen kind of the exuberance of home buyers in a frothy market. And I mean, I don't need to tell, I'm sure, a whole bunch of people on this call watching tonight that real estate is just another asset class. It has booms and it has busts and it has in-betweens. And there's nothing to say that there can't be periods of time where a real estate market in Toronto or elsewhere in this country, goes down and has a correction. But I do think the biggest single issue is employment, because employment or deep economic recession, where people can no longer carry the costs of their mortgage, they can't make their payments, etc. That to me is an even bigger sort of issue that sort of doesn't keep me up at night right now, but I think it's the bigger issue in sort of the overall housing market. As long as one can carry their home reasonably comfortably with a level of stress, which is why the government is imposing stress tests to assume a higher interest rate when rates do go higher, I think you're okay. I think employment overall is a very big factor in how the housing market sort of shakes out over time.
Thank you. I want to pivot away from real estate. We've talked about government. We've talked about micro and macroeconomics. I want to move into probably what's the bread and butter of your daily life, and that's the equity markets. And I'll begin like this. Despite the lingering COVID realities in our news cycle, equity markets continue to break new records. In fact, I think the TSX rallied to a new record today. What should people think about where valuations are today? And do you anticipate a pullback or a correction in the near term? I mean, I would have thought that last August, but then I would have been completely wrong. And thankfully, I didn't pull anything out of the market. But what do you feel about that?
So, so I'm gonna answer that, but I just want to go back to the housing because I think I didn't answer one question, which was about the condo market. I mean, just in a nutshell, again, I made the point around, I do think there's an evolution in condos. Yes, condos came off for a bit, but condos are coming back already. And I think, everyone needs to remember that the pandemic stopped a whole bunch of things, including, very, very strong immigration, not only to Toronto, but to Canada as a whole, but to Toronto in particular in the GTA, which was basically put on hold. Foreign students coming and living here and renting apartments and put on hold. So again, as you cross the divide, I suspect that the condo market in Toronto and Canada generally will become strong again. Where that kind of shakes out in terms of will square footage, price per square foot go back to its high? I don't know, but I think generally speaking, we can expect it to be a very robust part of the overall housing economy in Toronto and Canada. On kind of investing in the markets, I mean, valuation is it's a big word, and it's a bit of a loaded word. I think that, as an investor, valuation in terms of both the stock market and the credit markets and the bond markets is obviously numero uno in terms of what we think about, in addition to a whole bunch of qualitative things that we think about when we buy equity in a company, or debt for that matter in a company, but particularly equity in a company. And notwithstanding kind of hitting highs, I would say to you that it's very selective in the market. The markets have had a big run, but it's interesting. People think, wow, 2020, what a great year. And it did. It ended up being a great year. But people forget, and when you're not as close to it, you don't notice all the inter-year volatility of that, right? Markets fell the better part of 40%, some more, but 35 to 40, the TSX composite, the S&P 500, in February, March, when the full brunt of the global pandemic, and that Canada was part of it and North America was part of it. And it did end up being largely a V-shaped recovery in 2020, but a lot of the sharp rise came in the fourth quarter. And there were some pullbacks and quite a bit of significant volatility in the late spring and early summer. When people look backwards and you look at the year, you go, wow, it ended up being a nice equity year. Well, okay, but of course, hindsight is 2020. I would say that valuations overall are not necessarily totally overblown and outstretched, but that there are pockets. I mean, there are times in a market where you can buy an index and say, listen, everything's fallen. I'll buy an index, and all boats are going to rise when the market turns. What I'd suggest to you is now is not that time. This is a time for stock pickers in the equity markets. This is a time where you actually have to do valuation work to ensure that you're buying a company whose valuation is appropriate, where it's not frothy and overvalued. And it's a very sector by sector, industry by industry, company specific thing. you really just can't paint a broad brush and say the equity markets today are way overvalued. I mean, you can take that position, but I don't think that that's the right position. I think the right position is you have to be entrusted with a manager or broker, or unless you're competent to edit yourself, and really doing the valuation work to figure out that company that you're looking at, how does it fit into its sector, into its space, etc. I mean, you only need to look at the tech sector as an example, right? Tech sector had a wonderful 2020, in large part driven by stay-at-home, remote work, everything from Peloton to the FANG group, Facebook, Amazon, Apple, Netflix, Google, etc. And then you started to see a rotation again as you came up, as vaccinations rolled out in the fourth quarter, and it looked like the U.S. kind of said, we're actually going to start vaccinating toward the, in the late fall of 2020. All of a sudden, you saw this rotation out of what I'd call the high growth, technology driven, although technology drives a lot of other things, is like that old notion of a group of technology companies. There's a group of these FANG companies and, the Shopifys of the world. But technology today permeates lots of companies, including the likes of General Motors. But what I'd say is you had this rotation kind of out of it as people started saying, wow, the world's going to get vaccinated. This is becoming real, into the cyclicals, the industrials, the banks. I mean, look at Canadian banks. They had a brutal 2020 until, of course, we started, the vaccination started becoming more real, and the yield curve, the interest rates started shifting. And of course, interest rates started shifting in part because it's all tied to the pandemic, because vaccinations started rolling out. So you went from half of 1% to 1% to 1.5% quite quickly. But that's on the back of what the bond market is saying is the economy is going to get better, right? That's what the yield curve shift generally is saying. And so you had this kind of shift back into cyclical. So all of a sudden, the banks in Canada had more wind at their back because of course, as we move into higher interest rates, banks can make more money, right? They earn that spread between what they lend and what they borrow at. And so that all makes sense. But look at technology again today. So you had this kind of a little bit of a rollover in correction in technology. But again, tech has been booming again. Again, I think that...
Are we in bubble territory, though?
Are we in bubble territory? So I'm going to come to corrections in a second. But I would suggest to you that, and again, this is a Lieberman view. It's not a full KJ Harrison view. And again, for every one of me, there's someone that opposes it. But I believe that coming out of the Great Recession of 2010, largely because of technology, but not solely, but largely, that we're in a secular bull market that might last the next part of 30, 35 years, largely driven by technological change, okay? But that doesn't mean, even if you agreed with me that we're in a secular bull market for the next 30 years, it doesn't mean bull markets always have corrections, sometimes steep corrections. Sometimes black swans occur, like a terrorist attack or, 9/11 or a global pandemic, where you get these kind of 40% drawdowns periodically in the market. But, back to your question of, are we due for a pullback or a correction? Yeah, we're always due for a pullback or correction. That is the normal part of markets, kind of a 10%, 15%. And you saw that a little bit in technology, where some froth came out of the market. Now it's gone back up again. But technology is, in a sense, a very special place today, right? Because it drives it. It's different than 1999 and the dot-com, right? Those were companies that had no revenues and earnings.
Right.
Now we have technology that has real revenue, real earnings, and technology in healthcare and in car companies and in all kinds of industrial companies that are making them more productive. Technology has become disruptive, it has become more productive, and it is shaping earnings of companies that you wouldn't normally think about. You know, Walgreens, Walmart, great examples of, you wouldn't think of Walmart as a technology company, but they were nowhere in e-commerce. They hired a senior exec out of another e-commerce business that was a guru and changed it because they were like losing to Amazon. And all of a sudden, because of technology and becoming better at e-commerce, their earnings started to explode, and their stock market price exploded as well. So we're always on the lookout for corrections and pullbacks in the market. They are healthy for markets, these 5, 10, 50. I don't see in the near term, I believe that we're in the middle of a reflation trade here, writ large. The world is reflating coming out of a pandemic. And again, you tell me what the pandemic will do, and I'll give you a better view of where I think, the markets will go. Because of course, every time we think we're getting better, what happened last week? India, massive variance, massive amounts of death. So every time we think we've got a step forward, there's something that, is it going to spread? Is it going to come to Canada? How's it going to impact? All of these things impact the markets and can be reasons for pullbacks and market corrections. But I don't think that we're in some big bubble territory. Again, it's very sector, company specific.
Can I ask you a different question on the same theme? Then
Sure.
Are we maybe not in a parallel universe to what happened post-World War I, where suddenly there was this incredible decade of prosperity? Or is this the new roaring 20s of, 100 years later?
Right. So when we look at the evidence, at least in my firm, when you look at consumer demand, consumer savings as a result of pandemics, there is a lot of pent-up demand. Is this going to be the roaring 20s or some version of it? I mean, I think it will be some version of it. I'm not going to say it's going to be the roaring 20s because the contexts are different, the times are different. But I look at, global PMI, the manufacturing index, right? Hasn't been this good in decades. Inventory levels are low. Consumer sentiment is very high. Consumer savings as a result of the pandemic is extremely high. So I think it's fair to say that there is a lot of pent-up demand. And, when you look at the GDP of the US, don't forget that 2/3 plus of US gross domestic product is the consumer. And that consumer has been tamped down for 14, 15 months. It's getting a little better, but I think that there is a bunch of pent-up demand. The bigger question, back to, is there going to be a pullback or correction, is, you've got stock market prices or the price of the S&P 500 or whatever relevant index, and then you have the other part, right, the denominator, earnings. And so where are earnings going to be? And we're really just sort of, getting started with Q1 earnings. But I think that what we're seeing, at least early on, is really strong earnings. And so the question is really, are earnings going to be as robust or more robust? And is growth going to be big? No one knows the answer to that in truth, but I think that there are lots of reasons to think that earnings are going to support a lot of valuations. Again, there are pockets, and that's where you have to do your valuation work to decide if things are a little bit frothy or too frothy to pull back.
Okay.
And just to be clear, I am not a roaring, raging bull. Like, I think this is a time, everyone is different. It depends on your own portfolios. This is a time that you should be scouring your own portfolios from a risk management perspective. And hey, if you've got big gains embedded in them, take some money off the table. And don't, that phrase about pigs getting slaughtered, right? So you need to make sure that your risk management, and this is all individual. This cannot be, this is my advice to whoever is listening here tonight. It's about your own goals, where you are, what you need in order to live your life the way you want to live. So it's very, very individual, but it is a time, if you've had big gains, to sort of say, hey, maybe I should kind of take a little bit off the table and be ready for the normal pullbacks in the world, where you can have some dry powder to put to work at the appropriate time.
I want to move into the cryptocurrency space, which is obviously incredibly topical, very exciting, but very little understood by most, I think, most normal folk, myself included. So I want to ask you how you feel about the cryptocurrency market. It seems there's increasing adoption by big name personalities endorsing crypto. Is it a new asset class that people that were skeptical should start paying attention to?
So I think the short answer is this, and I am confessing, I am not an expert in cryptocurrencies and crypto assets, but it is for sure a new asset class. But with any asset class, it doesn't mean that it has permanence, but it may have permanence. But we don't know what degree of permanence it has. So here's my view on cryptocurrency for those that may not be familiar, or those that are perhaps invested in some. The fact that Main Street players are putting money into it is encouraging. But again, I'd suggest to you that it always depends on who you are and who they are. I mean, if a multi-billionaire puts, a couple of $1 million into cryptocurrency and they lose it, it's all relative, right? Yeah, no one likes losing a couple of $1 million, but if you're a multi-billionaire, a couple of $1 million is not that much. So it is fair to say that it's new, it's speculative. No one knows where it's going to go yet. What I'd say to you is, if you're interested in it, the way to play it is like any capital allocation exercise. Make sure, because it's new and because it's extremely volatile, you could just look at the market of Bitcoin or Ethereum, two of the, Bitcoin for sure is the largest, most renowned, most widely known cryptocurrency today. You just look at a chart and can see that it's pretty volatile. So you need to be able to take the volatility. You need to be able to take the drawdown. And so the question becomes, how much money am I going to allocate to it? 5% of my financial assets, 2%, 1%, 20%. It all depends on how much volatility you can stand, what will let you sleep at night. There's a lot of FOMO around cryptocurrency, right? A lot of fear of missing out, okay, FOMO. And FOMO occurs particularly when there's some new hot asset. The SPAC market, which is, again, a real market. It's not an asset per se. It's a vehicle to take companies public. It's a vehicle to the capital markets, but it shares similar things where you have to understand the volatility and you have to understand what you're getting yourself into. So I do think it's a real asset class. It's unclear to me, and I think unclear to many, whether it will ever really serve as a widely used currency, that it will replace the dollars in our pockets, what we call, central bank fiat currency. It's very unregulated to date. And so you have to think about, are governments just going to let this sort of currency take shape without eventually starting to put its regulatory clause into it? And I'd suggest governments are, if it becomes more and more real, more and more used. But I think that its transaction power is not there today. You really can't use it to buy most mainstream things. We can all point to something or someone that's allowing crypto, Bitcoin to be used, but, mainstream, it really isn't, it has no transaction power today. So I think we're all watching it. The technology that underlies it, which is called blockchain, that has a lot of utility, but blockchain is not crypto. Blockchain is a technology that allows for the disintermediation, the transparency, the ledger of crypto assets to kind of stay away from intermediaries like banks, etc. But and blockchain has real utility across supply chain management and lots of other uses, I think. So a really interesting technology, which I think will just become more and more utilized across lots of different spaces in the economy. But crypto assets themselves, it is a little bit today like going to the casino. So what I'd suggest to you is, but that's fine, right? We all get out of the markets what we want to get out of the markets. If you want to treat the market like a casino, you can treat the market like a casino, but it's probably not the best thing to do with the bulk of your financial assets. If you want to put a small allocation to it relative to your net worth and your financial asset worth, go ahead so you can see what it does. But it's very volatile and you need to be prepared to accept that volatility.
Okay. Fair enough. I mean, there are hundreds of smaller cryptos that don't get the media attention of Bitcoin and Ethereum. And I'm wondering if there's any space for those to have a future as a usable product, or is it really going to be Bitcoin? Or is it ultimately going to be government that steps in and says, well, we're going to develop our own form of cryptocurrency and bye-bye Bitcoin? Or is there an infrastructure so developed already that governments will not be unable to compete or catch up?
These are all good questions, Eric.
I try. Nobody knows. Fair enough. Okay, let me pivot to a different area. Because this one I find very interesting because I think of the math of it, and it goes back to debt. You spoke about, personal debt. People have record personal debt because rates are at record lows. So while emotionally, you could speak to my wife and she hates owing money. I'm on the other side of the coin. I love owing money, but I love owing money in this environment because mathematically speaking, the spread between what you can spend to owe the money and what you could make in another area of, equity markets or otherwise, it seems that there's an arbitrage opportunity where you can make the spread. Are you concerned about people that are choosing to do that? How do you feel about investing with leverage during this environment of truly historically low rates?
Right. So again, it's somewhat similar to the discussion around crypto assets, which is, generally, I think utilizing leverage is bad because for the masses, because it ultimately leads to potential irresponsibility, imprudence, and can get people in trouble. Now, having said that, it's a matter of, again, interest rates, a level of sophistication, and a level of comfort around what happens if things go wrong, right? I am paid to be a risk manager, right? Yes, people want to make money, but the only way you make money is ultimately by managing risk. Benjamin Graham, who is the father of value investing, was a professor at Columbia University, favorite quote of his is, The essence of investing or investment management is the management of risk, not the management of returns. So if you chase returns, it's a mug's game, right? And to illustrate that, it's a mug's game because of the way generally people invest. And we can all say, I don't invest like that, and I know how to invest properly. But, Peter Lynch, who ran Fidelity Fund, one of the largest mutual fund companies in the world, very interestingly, Dalbar did a study, an economic study, a performance study of Peter Lynch's flagship Fidelity investment fund. 30 years of history, Peter, his fund returned over those 30 years, I'm going to get this directionally right, about 11.5% annualized. That is, 30 years later, looking back, he generated about 11.5% a year, right? There'd be bad years and good years, but smooth out 11.5. But his investors, the clients in the mutual fund, averaged about 4.5%. Well, why that discrepancy? Well, because those clients, as sophisticated or unsophisticated from an investment perspective as they may be, they went in at the highs and went out at the lows and didn't have their emotional capital. Investing, to me, is about risk management and preserving clients' emotional capital. So back to your question of leverage, well, what's going to happen if you or I lever too much? Well, we're making money because our money, we're getting money cheap, and we're, as you say, arbitraging. So I'm making 8% or 10% or more, and I'm paying 2%, and I keep the difference until things go bad, which could be fine as long as I can handle that leverage and the change in interest rates over time, right? It's about interest rates and what happens if a market, implodes and has a severe correction for a period of time. Do I need to get out at the worst time possible? Or do I have the financial wherewithal to ride out the storm? And unfortunately, for many people, they don't have the financial wherewithal. And that's what I mean about the prudence or imprudence. So again, it's about responsibility, and you can use leverage to your advantage if you know what you're doing and can handle it and can ride out volatility. But if the margin call comes and you've got to sell at the worst time, then it's not going to be a pleasant experience. So I think you just have to use leverage prudently.
Okay. I want to just pause for one moment. I have 3 more questions I want to ask you, and then we're going to wrap things up. Initially, when we contemplated the session, we had talked about potentially taking questions, but I see that the hour is late and we've covered so much ground. I did put in the chat box your direct email, plieberman@kjharrison.com. I encourage people with questions, if that's okay with you, Philip, to send you an email and maybe arrange a call or just correspond by email to address any additional questions for you. I want to ask you about the dollar, because again, the dollar rose today. I think we went over 81 cents. Haven't seen that in a long time. And so here's my question. I've always believed that the opportunities for greater returns lie south of the border. Clearly, our vaccine policy is placing our economy at a significant disadvantage to the US. With that in mind, is an 80 cent or 80 plus cent dollar here to stay? And do you anticipate further appreciation in our currency?
Well, again, it's currencies are a very complicated thing, and the pendulum of currencies, and I am not a currency expert, but currencies swing, and they can sometimes swing quite dramatically. And the fact that the Canadian dollar has strengthened against the US dollar, significantly over the last few months, you're right. I mean, the truth of the matter is, over time, I think what happens is when we look myopically at a small period of time, we might go, well, if I wanted to buy Apple as an example, because everyone knows it, I've got to buy it in US dollars. And so, well, my Canadian dollars go further today, but of course, I've now done it in US dollars. And if the US dollar continues to deteriorate against the Canadian dollar, whatever return I get is going to get diluted, right? Because if I get a 10% return, like an investment return, I'm buying Apple, but the US dollar weakens by 2 or 3%, that 10% is now 7% or 6% or whatever it is. And so, but I'd say that currency is a difficult thing in kind of the short term to look at. I think that, I mean, there are obviously hedging strategies, for example, that we use at our firm to mitigate against currency fluctuation. It's harder to do at kind of the individual retail level, but on the assumption that most people are taking a medium to long-term view on their investments as opposed to a short-term opportunity, quick flip, hot money kind of thing. On a medium to long-term view, I think you'd find that currencies kind of smooth out more or less. And you're not going to not avail yourself of the breadth and depth of the US capital markets to invest in. I think it's, should I buy Apple or any other American, and not to pick on Apple, some American company today because the US dollar seems to be weakening against the Canadian dollar, and therefore, I got to convert, and then my returns might get diluted. Yeah, short term, not great, but I think that in the medium to long term, currencies tend to play themselves out. And frankly, it's another diversification tool, having some exposure to world-class currencies. Some might argue whether the US dollar is a world-class currency, but I'd suggest it still is.
I would agree with you. For the participants on our call tonight who are seniors, I'm wondering if you could maybe address any steps they should be taking to protect their assets and ensure a smooth transition to the next generation in their families.
Right. So, big question, right? I mean, it goes without saying, obviously, from an estate planning perspective, everyone should have a will and not leave themselves without a will before they pass away, because it's just mayhem and more money for the government. So, a lot of what we do at our firm, and most firms do this, is spend time ensuring that the estate planning of our clients and of you is done properly, and you've got the proper things in place to pass on your legacy to the beneficiaries. Having said that, today retirees are in and have been for decade plus a difficult position because a lot of people want income. And of course, in a 0% interest rate environment, more or less, it's very difficult to get income, right? That old 60-40, sort of balanced portfolio is out the window, because there is no traditional fixed income today that serves that 4, 5, 6, 7%, whatever number you have in your head as the fixed income side of your ledger. Very difficult, in fact, near impossible to accomplish in today's environment of near zero interest rates. But there are alternatives. There are proxies to fixed income. There are credit hedge funds, which are bond funds. There are bank loan funds. There are other credit products that are very good proxies to the traditional fixed income market that could provide that income source, so that you're not just in the equity market. And I would suggest that for those that haven't heard of them or haven't looked at them, again, you can send me a note and I'm happy to talk to you more about them. But they're very excellent securities that provide you with income, capital gains, and are uncorrelated, most importantly, to the equity markets. That is to say, they behave differently, right? Because again, what's the holy grail of investing? It's sort of putting together a bunch of different asset classes that provide good returns, but also don't all behave the same way, so that when you go into correction, well, they all go down. It'd be nice to have assets that when there's an equity correction, some of my other assets are still doing just fine, thank you very much, so that your blended return is still an acceptable risk-adjusted return on your assets. So there are things to do, but that old 60-40 is a tough one.
Okay. I want to ask you one final question. It's kind of a personal question. You manage large portfolios for high net worth clients, and that comes with a great level of trust from them and immeasurable responsibility for you. In doing so, what keeps you up at night?
Well, I wanted to be a cantor, so that keeps
Never too late. You're on your way.
Look, I think that the things that keep me up at night are the things that keep us all generally up at night, right? What as an investor, as someone that has built some asset base that you want to protect, right? Capital preservation is first and foremost important, and then you want to grow it at reasonable rates. Although again, I'd suggest to you that one of the things that I'm a big proponent of is what's called goal-based investing, which is figuring out, Eric, what do you and your family need to achieve your goals, as opposed to you saying, Philip, here's a pile of money, just go and make me the most money you can make me. I mean, okay, but that doesn't do a lot for me, and it certainly doesn't do a lot for you, right? It's better to figure out, what do you need? So you're not sort of sitting there and trying to beat Joe next door, who says, I got 20% on this, but you never asked him what risk he took to get that 20%. So again, I think it's really important to understand the risk that you take, the risk that you need to take in order to meet your particular financial goals and objectives. I think the things that really keep me awake at night is I'm worried about, back to your question about leverage, I'm worried about the ETF industry, which is exchange traded funds, which seem marvelous to a lot of people because they're a little less expensive than going to a guy like me. And there's a whole bunch of us in the investment industry that are congregants at Beth Shalom. But the ETF industry is a product of the post-Great Recession of 2008, 2009, and it's basically copying different indices. And back to your question about valuation at the beginning, there is no valuation work. When people pump money into an ETF, if that ETF has Apple and Facebook and I'll pick General Electric as kind of a big part of the index, when you throw money in, you are raising the valuations of those companies without even looking at the company because you're trying to mimic an index. So you've got this flood of money into ETFs by sort of the retail investor. Again, ETFs can have their place in a portfolio. I'm not saying that they're not good, but I'm worried about them because I find that you get floods of money into them with no valuation work, but you haven't really yet been tested around when floods of money come out of them by some big event in the marketplace. And we saw some of that in February, March of 2020 when the pandemic hit and you started to have liquidity issues. But that concerns me. I mean, listen, geopolitics is always a big issue as investors, whether it's Iran, not just on Israel, but just Iran generally, South Korea. And frankly, technology issues and sort of cyber technology issues. Is that the kind of next world war? And of course, we've all seen pockets of that, whether you were hacked or whatever. But technology is obviously a great thing in many ways for us, but it poses its issues as things get bigger and deeper and more sophisticated. And so that's an issue that I think, for governments and central banks and investors around the world is a concern that we're watching for.
Thank you. I want to thank you very much, Philip. I just want to give a disclaimer to everyone. Philip just took the time out of the goodness of his heart, not to, just to be clear, this is not a sales pitch and this is not a way to look for new clients. It was really just, we asked him if he would do this for us as a member of Beth Shalom, and just to help people who have a lot of economic questions about their finances, about the future of the economy, government, etc. And we covered a lot of topics this evening, and I just want to thank Philip for taking the time out of his busy schedule to do this for us, as well as taking the time out of his davening schedule, because he's a regular morning, noon, and night at the Beth Shalom. And I did, again, put his email in the chat box, and if you do have questions for him, I encourage you to please reach out. And I want to thank everyone for joining us this evening, and thank you again to Philip.
My pleasure.
Thank you, everyone. Laila Tov.
Good night, guys.